Hello everybody, welcome to Accounting Superstars. This is the Accounting Superstar Station. I'm Professor Don Bush. I've been teaching accounting for about 30 years and been a CPA for about that long, and I've got lots of great ways to explain accounting. So today we're going to learn about Sale-Leaseback. Lessee perspective, we're using the new rules here. This is the second example. In fact, this is the 8th video on leasing that I've done. It's hard to believe I've done 8 videos. And if you're struggling with this one, I would suggest going back and reviewing the other videos, and it'll get you up to speed. Now, in this example, we're using the exact same information to keep things as simple as possible. The exact same information as the last example that we did, example 1. Example 1 turned out to be an operating lease. Now in example number 2, it's going to turn out to be a financing lease. So that's how it's different. I just changed one of the details to make it a financing lease. So the way this all works is that we have some new rules for accounting for leases. These are new rules. They just have been enacted in the last 2 years or so. And what it is in the past, companies would go to great lengths to have their leases classified as operating leases. And what that would do is a business could buy an asset and have a related liability, and since it was called an operating lease, it didn't have to be placed onto the balance sheet, which meant that certain ratios like the return on asset ratio would look a lot better. Also, the debt to equity ratio would look a lot better too. So the accounting profession thought, well, we need to change this. We need to make financial statements more comparable among companies. And so here we have some companies that buy assets, and we have some companies that lease assets, and their financial statements are hard to compare, even if they're in the same industry. So the accounting profession said, we are just going to make everybody, no exceptions here. Well, maybe just a couple of little tiny exceptions, but really no exceptions, that everybody will have to put assets and liabilities on their balance sheet. So either way, operating, financing, it's going to go on the balance sheet. So today we have a sale-leaseback, which at first is a little confusing, but we'll get through it. And it'll turn out to be a financing lease. So we'll see how it handles. It turns out that it's pretty easy. This is one of the easiest ones. Also, in this example, we also have what do you call it here? We also have a bargain purchase option too. And you're going to see it behaves exactly like a guaranteed residual value. It behaves the same way. So there's something new, but yet it's not very new. So here we go. Let's look at the facts here, folks. Let's see what's going on. And as I always mention, when I work on these leasing problems, a lot of them are very complicated. And so I like to just list the information out. And I also like to put all the numbers in a column so that way I can use them and copy them down into my spreadsheet and use Excel on this. My goodness, it's way easier with Excel. So here we go. Understand the facts. 1.1, when we get to a construction, owns and uses an earth-moving truck but is short on cash. Number 2, Joe investor has lots of money and would like a safe investment with a good ROI. 1.3, per when we get to its books, truck's original cost is $500,000. They paid $500,000 for that big giant truck. 1.4, per when we get to its books, accumulated depreciation. They depreciate assets at a rate of $50,000 per year. So apparently they've had this truck for about 2 years and have accumulated depreciation of $100,000. Joe investor agrees to purchase the truck at fair market value. When we get to it, sells the truck to Joe investor for $450,000. Now that might be what's going on, and who knows, maybe even title the truck passed to Joe investor. But you're going to see, since this is going to end up being a financing lease, when we get to it, is really not selling this truck. it's not what it appears to be. So 1.6, when we get to it, construction agrees immediately to lease the truck from Joe Investor. The lease begins on January 1st, 2001. The truck is not of a specialized nature. This truck is useful to lots of different companies, a lot of different people. It wasn't specially built for when we get to it. The lease is non-cancelable, and the lease term is 3 years. The truck's remaining economic life in years is 8 years, so 3 of those 8 years is going to be leased to when we get to construction. The estimated salvage value at the end of the lease, and this is unguaranteed, I put it in dark red here so it stands out, is $300,000. So this is the estimated fair market value, and I put it unguaranteed in red because it's important to distinguish between guaranteed and unguaranteed residual values. You handle them differently. 1.13, there's no lease renewal options at all. The lease will not be renewed. However, with 1.14, here's something new that we have not covered yet. Lease contains a bargain purchase option, and when we get to it, we'll buy back the truck at the end of the lease for $200,000. Now, how is that a bargain? Well, they expect the truck to be worth $300,000, and if they buy it back for $200,000, they're automatically making $100,000 off the truck here. So it's a bargain purchase. They're getting the truck at a good deal, and I'm sure they won't turn it down either. So here we are. 1.15, Joe Investor's interest rate is equal to when we get to its incremental borrowing rate, which is 8%. And this is important. If the Joe Investor's interest rate was different than when we get to its incremental borrowing rate, we would use the lower of the two. The reason why is a low interest rate causes a higher present value, which means that we probably will it'll be more inclined to cause a financing lease if the interest rate is low. 1.16, lease payments are made annually at the beginning, January 1st, 2001, the beginning of each year, which is typical for a lease. And 1.17, when we get to it, depreciates equipment on a straight line basis, $50,000 per year. And 1.18, no executory costs in the lease agreement. So I wanted to keep things easy for us. Step number 2, here we go, determine the annual payment. Now, always in the past, we would use the residual value, the unguaranteed or guaranteed residual value. But we have a bargain purchase this time, so we're going to use it. So the bargain purchase option is $200,000. The interest rate is 8%, lease term is 3 years, and the present value of the bargain purchase option is $158,766. And how did we do that? Well, we find it the exact same way as we always do. We go up here to formulas, go to financial, go down to NPV, and up comes a little chart. And what we're doing is we're finding the present value of a lump sum. That lump sum is $200,000 at the end of 3 years. Now the rate is 8%, so all I have to do is click on it. The value for year 1, if you've been watching these, is 0. The value for 2 is 0. However, the value for 3 is $200,000. All I have to do is click on it because I have it all written out here. Now, all I would have to do is click OK, and I would have the answer. But since I already have the answer, I'm going to cancel out, otherwise it messes things up. Present value bargain purchase option, $158,766. So there we go. So coming down to part 2.2, determine the amount to be recovered through lease payments. Well, this truck is worth $450,000 at the start of the lease. That's the fair market value that came from up above in the information. Less present value of the bargain purchase option, $158,766. We found that right up above. So the amount to be recovered through the lease payments is $291,234. Now we're going to determine the payment. Here we go. A lot of textbooks in these leasing problems, they just tell you what the payment is, but now you know how to find it. So here we are. Determine the amount of annual payment, $291,234. We got that from right up above. The interest rate is 8%, 3 years, and at the beginning of each year, The amount of annual payment is $104,637. How was that found? Well, we got to use Excel again. We go up here to formulas, go to financial, go to PMT for payment. PMT, there you are. The rate is 8%. The number of periods is 3. All I have to do is click. Present value 291, 234. All I got to click there. Now the type, what you do with the type is you type in the number 1. That number 1, when you type in the number 1, it tells the computer that payments happen at the beginning of each year, not at the end. Now, if the payments happened at the end, you would just leave it blank or type in 0. But we are typing in number 1 here. So all I would do is click OK, and the answer would appear, but I'm going to cancel out. So the annual payment is $104,637. Add any executory costs. There are no executory costs with this lease. So the total annual lease payment is $104,637. So coming on down. So the amount to be capitalized. Here we have 4 items that we have to consider. This is a very important step here, folks. This tells us how much the lease will be capitalized at, the capitalization amount. So here we are. So here are the 4 things. Rental payments, well, $104,637. We found that right up above, $104,637. Bargain purchase option, there it is. We have a bargain purchase option. Number 3 is guaranteed residual value. Now there's no guaranteed residual value. However, there's unguaranteed residual value, but we don't include unguaranteed. So we'll leave it blank. Penalty for failure to renew lease. 0. Here it is. The lease will not be renewed. There's no penalty. But what we're really interested in is we're really interested in the present values of these. So we're going to have 3 payments of $104,637 as calculated up here. And the present value of 3 payments of $104,637 at 8% interest happens to be $291,234. So we will use that number, folks. $291,234, there you go. And the present value of the bargain purchase option is found right up here. There it is, the bargain purchase option, $158,766. There you go. If we add up the present value of the rental payments and the present value of the bargain purchase option, it all adds up to $450,000, which is not a surprise. Okay, so now we have to determine, well, is this a financing lease or is it an operating lease? And if all the answers were no, it would be an operating lease. But look at this, we've got yes, and we have a yes here. Anytime there's a yes, all it takes is one yes, and we have a financing lease. So let's go through them. You already know what the answer is. This is a financing lease, but let's go through these 5 tests. Test number 1, is there a transfer of ownership at the end of the lease? In other words, when we get to a construction, is it written into the lease that the truck will revert back to when we get to a construction as far as ownership goes? And in our description in the problem up above, there was no talk about that, so we're listing that as no. However, test number 2, there is a bargain purchase option, which means that when we get to it, construction can buy that truck back at a price they can't refuse. So test number 3, the answer is no. So how did we get no? Well, is the lease period 75% of the economic life? And what you do is you say, okay, the lease is 3 years. The economic life is 8 years. So 3 divided by 8 is 38%. That is not 75% or greater. So the answer is no. Now, the present value of lease payments, does that equal 90% or more of the fair market value? Well, the present value of the minimum lease payments is $450. Where did we get that? We got it from right here, just in the previous step. Fair market value. Well, the fair market value at the time the lease is signed is $450. Well, if you do a little division, you get 100%, and 100% is greater than 90% of the fair market value, so the answer is yes. Last test, specialized use. Well, this is a big dump truck that is used in construction, and when we get to it, construction is not the only company that could use this truck. It was not specially built for when we get to a construction. Now here is something that is different. Is this is a financing lease, and what we're going to do is we're going to treat it as a note payable. So here's what's going on in essence. When we get to a construction is, I guess in air quotes here, you'd have to say is selling the truck to Joe Investor. But in reality, when we get to a construction is just keeping the truck. They're going to own the truck. So we're going to treat this as a note payable. In reality, the truck is not really changing hands. So when we get to construction, it's going to keep the truck on their books. They're going to keep the accumulated depreciation on their books. They're just borrowing money is what they're doing. So here we are. So we have to create an amortization table, folks. We always do with these leases. So here's what we do on 1-1 2001. At the beginning of 2001, we have to write down the carrying value of the note payable. Well, the carrying value of the note payable is going to be $450,000, which is the fair market value of the the minimum lease payments. It's the amount to be capitalized, if you want to say it that way. So here we go. And here are the payments. On the day the lease is signed, January 1st, 2001, the same date as the date right up above, when we get to a construction, it has to make our payment right away. So they receive $450,000, and right away in the next minute or so they have to make a payment of $104,637. So money is just going back and forth, and this $104,637 is going to reduce the carrying note of this note payable, because these payments are made at the beginning of the lease, not at the end of each year. So here we go, 450 minus 104,637, and you get 345,363. Now, at the very beginning of 2002, on January 1st, 2002, when we get to construction, makes another payment. And the payment is for $104,637, but this time there is some interest because time has gone by. What's the interest rate? The interest rate is 8%. And you have to go 8% of what? Well, 8% of the carrying value right up above here. So 8% of 345,363 is 27,629. So we're going to reduce the note payable. Here's what we do. We go 104,637 minus away the interest, 27,629, and you end up with 77,008. And the carrying value of the note payable is reduced down to 268,354. How'd that happen? 345,363 minus 77,008 is 268,354. Here's the last regular payment. It happens on January 1st, 2003, right at the beginning of 2003. The payment's for 104,637. We have some interest. You know how to calculate it. And the note is being reduced, and so the carrying value of the note is now 185. Well, at the very end of the lease on December 31st, 2003, I'm going to make this a little bit bigger so you can see it. December 31st, 2003, at the very, very, very end of the lease, when we get to construction, is paying that bargain purchase option. So check this out. The bargain purchase option shows up right here, $200,000. And there is interest. How was that calculated? Well, it's 8% of the previous value. 8% of 185. 185 is 14,815. And we're going to reduce the note payable. All you do is 200,000 minus 14,815. You get 185, and guess what, folks? It ends up being zero, because 185 minus 185 is zero, and it should end up being zero, or very close to it, folks. If you're off by $100 or $1,000 or 500,000, you did something wrong. When we get to construction is not really selling this truck. I know the lease says that they're selling the truck, but when we get to a construction is really just borrowing money on a temporary basis. They're calling it a lease, but it's a loan is what it is. And so when we get to construction is going to keep the truck on their balance sheet, and they are still going to depreciate the truck at the same old rate that they always have at $50,000 per year. That's not changing. The journal entries are really quite straightforward. So here's the journal entries for the first year. For year one, well, we have to make an entry for getting all that money. When we get to a construction, received cash of $450,000, and we're recording it as a note payable. They owe this $450,000, and look at this, it's right up here on the amortization table. It's the beginning balance. Next, we have to record the first payment, which is super easy. The first payment happens just minutes after getting the $450,000. Really, no time has gone by. So note payable, 104,637 comes from right there. Cash, 104,637, and that reduces the liability down. Okay, recording the adjusting entry at the end of the year, December 31st, 2001. Well, December 31st, 2001 is really, really close to January 1st, 2002. They're only a day apart. So we're going to use the numbers right on this column here. So interest expense, 27,629, got it from right there. And interest payable, 27,629. There you are. And lastly, what we have to do is record the depreciation at the end of the year. Depreciation expense, 50,000. It's the same depreciation rate that they've always used for that truck. Accumulated depreciation, 50 grand. There we are. The entries for 2002 are easy. We're going to use the line right here, the second line here. So note payable, 77,008, got it from right there. We're decreasing that note payable. Interest payable, 27,629, that came from right here. And cash, 104,637, came from right there. So interest expense, here are some adjusting entries at the end of the year, December 31st, 2002. Interest expense, 21,468. Where does that come from? It comes from right there. Interest payable, 21,468. Depreciation expense, same old entries before, same old depreciation schedule as before. Let's go to the third year, the final year. Record the lease payment at the beginning of the year. Well, that's right in here. So we're going to use these numbers right in there. Note payable, let's see here, 83,169. There you go, got the number from there. Interest payable, 21,468, got it from here. Cash, there's your cash yearly payment. And we're going to record interest expense here at the end of the year. This is December 31st, 2003, the end of the year. Also the end of the lease too. So interest expense is 14,815 and interest payables 14,815. And at the very same moment here, they're recording depreciation expense of 50 grand. That's same old entry, same old amount. And lastly, on December 31st, 2003, December 31st, 2003 is a busy day. They are paying that bargain purchase option. So they are paying cash of $200,000. It's reducing the note payable of 185. There we go, 185. And interest payable of 14,815. So there we go. There's our entry, and it all ends up being zero. So everything is good. When we get to a construction, still has the truck, the lease is over, and everything has been paid back. So the moral of the story here, folks, is with sale-leasebacks, what we need to do is we need to determine if the sale-leaseback is an operating lease or a financing lease. And if it's an operating lease, then follow the new rules of operating leases. And I've got several videos now on operating leases using the new rules. And just follow that procedure. On the other hand, if the sale-leaseback is a financing lease, the company is just borrowing money. So it's like a loan. And you can follow these steps and do the problem. I hope that you found this video helpful. If you want any more videos on leases, you're going to have to let me know. Otherwise, this is going to be the last one here. I'm going to move on to other topics. Hit that like button and the subscribe button. Let me know if you liked it, so that way I'll keep making these videos. So until next time, over and out.